Earlier in August, ratings agency Fitch downgraded U.S. Treasury debt from the top rating of AAA to AA+, their second highest credit rating. Now, Fitch cited a growing budget deficit and reduced confidence in governance after the debt ceiling standoff as the reasons for the downgrade. And what did most traders do? Well, you guessed it, they sold their stocks and bought treasuries. I guess they weren't too alarmed by that AA+ rating. By the way, treasuries, or United States Treasury securities, are simply bonds issued by the U.S. Department of the Treasury. They come in different flavors and have maturities that run anywhere between 4 weeks to 30 years. Now, the last time a credit ratings agency downgraded U.S. debt was back in 2011, when Standard & Poor's, also known as S&P, likewise moved the U.S. from AAA to AA+ after the 2011 debt ceiling debacle. Back then, S&P cited a growing budget deficit and reduced confidence in governance after the debt ceiling standoff as their reasons. Of course, after the 2011 debt downgrade by S&P, the US government launched an investigation into S&P's role in the 2008 financial crisis by rating mortgage-backed securities as AAA. S&P's CEO stepped down a mere 18 days after that downgrade, so we'll have to see how this go-round plays out for Fitch. So is this downgrade cause for alarm for investors? Well, hardly. These debt ceiling debates now seem to be just another feature of our government. As I mentioned back in February and in September of 2021, politicians would have to be profoundly foolish to allow the government to default. And I think we have enough history with all of the sound and fury surrounding these debt ceiling debates to understand that it's just theater. So that brings us to the treasuries themselves. As with any bond, there are risk factors that come into play for investors: credit risk, interest rate risk, and market risk. Credit risk is simply the risk that you won't get paid back. When you buy a bond, you're literally giving the bond issuer a loan. At the end of the loan, the bond's term, the borrower promises to give you your original loan amount back. By the way, interest rate risk is simply the risk that your bonds will decrease in value with an increase in interest rates. We all felt that last year. And market risk is the risk that your bonds will drop in value should overall market conditions deteriorate. And we're going to focus on credit risk here today. Assessing a bond issuer's creditworthiness is where all these credit ratings agencies come in. Buying a bond from someone with a AAA rating means that there's a much lower risk that you'll get stiffed by the lender. However, if you're borrowing from someone with a BBB- rating, well, you'd better ask for a much higher interest rate. Bonds with a rating in the B's, C's, or D's are politely called investment grade or speculative. People less concerned with being polite call them junk bonds. So thinking back to the Treasury downgrade, it's not like they've suddenly become junk bonds. The market for US Treasuries is perhaps the most scrutinized in the world. In fact, Mohammed El-Ariane, the former CEO of bond behemoth PIMCO, asked of the debt downgrade, why now? These debt ceiling standoffs are not new, and there's still no other country that could replace the US in terms of reserve currency. So the downgrade seems a bit arbitrary at this time. In fact, the dollar strengthened after the announcement. While US Treasuries have been downgraded by Fitch, I still don't see how they aren't among the safest investments in the world. It's always important to understand that a bond's credit risk is never zero, but I have a hard time imagining that you can find something with lower credit risk than US Treasuries, even with all this debt ceiling mess. Now, if the government continues to issue treasuries like it has recently, will inflation continue to be an issue? Sure. Should you sell your treasuries if you own them? Absolutely not. Now, should you change your investment strategy because of this debt downgrade? Absolutely not. But if you are still worried about how much you'll have saved for retirement, then check out this video to learn more. I'll see you there.